Companies often pay more than the book value for the company or part of the company that they're acquiring. And consider that book value is based on things like the cost of an asset, and it's reduced by its accumulated depreciation. So when you're buying something, you normally pay fair value. Well, you do pay fair value because that's a definition of fair value. The fair value is what somebody will pay for something right at that particular time. So it's not at all unusual to say that a company will pay more than the book value for an asset, including this investment. So Grand wants to purchase 30% of Chico's outstanding shares. Chico has assets of $500,000 and liabilities of $300,000. They get the whole package, not just the assets, but the liabilities too. The net book value is the same as equity. After all, assets minus liabilities equals equity. So equity, our net book value, is $200,000, the 500 minus the 300. And 30% of that is $60,000. That's the book value. It's determined that the equipment is undervalued by $60,000 and the patents are undervalued by $40,000. Therefore, the fair value of Chico's net assets is $300,000, the book value of $200,000 plus the 60 and the 40. That's your $300,000. So Grand offers 30% of $300,000 or $90,000 for 30% of Chico. 30% of the book value is only $60,000, so they're paying $30,000 more than the book value. That extra book value is assigned to the identifiable assets, the equipment that was undervalued by 60, 30% of which is $18,000, and the patents that were undervalued by 40, so 30% of what they're getting, 30% of the patents is what they're getting, and that's $12,000. So that's the extra $30,000 that Grand is paying for Chico. If the negotiated price was more than $90,000, the additional amount would be called goodwill. They're willing to pay more for the reputation of the company, its reputation with customers, or even with vendors. For example, if Grand paid $125 and the fair value of the net assets was $300, Grand would have assigned $30,000, 30% of the $200,000 book value. Then they would have gotten the $18,000 just like that, $12,000 for the patents just like that, and the balance of $35,000 can't be assigned to any particular assets. They can't identify them, so they assign them to a new asset called goodwill. Each year, Grand would amortize the definite lived or lived assets. In other words, equipment has a remaining life of useful life of 10 years. So 10 divided into 18,000 is 1,800. Patents have a remaining life of 5 years. So that 12,000 divided by 5 is $2,400 of additional amortization. However, goodwill is not amortized. It is examined each year to see if it's lost its value, but that's a story for another time. Goodwill is not amortized, so there's no additional amortization because it has an indefinite life or not, but we can't assign a particular life to it, so we say that it's indefinite. We don't know. Not forever, but indefinite. So each year, Grand would record equity in the investee income, decrease in the retained earnings, because that's what happens with amortization, right? Any kind of an expense decreases net income. If net income goes down and that gets closed into retained earnings go down. And it decreases their investment in Chico.